Welcome to another episode of Phillip Trading Podcast. My name is William, and our speaker today is Yong Shen, which is our Senior Marketing and Dealing Executive at Phillip Capital. So the stocks market continue to decline when investors faced with difficult choices right now. Should they continue to hold their losses of the loss-making position at the moment, or they should wait for recovery? Yeah, should they cut it, or they should continue to hold until the market recover? So yeah, this is something that we are going to discuss today. Okay, so Yongshen, how have you been?
Hi, William. Thank you. Yeah, I've been doing very well.
Okay, good to see you again. Okay, so let's start our podcast today. So historically, stocks market has the worst performance in September. Okay, with S&P 500 drop approximately 9% last month. So as we move into October, do you think the equities market sentiment will recover, or investors should anticipate further correction in October?
Okay, so for the S&P 500 is down about 23% on the year of 2022, like with a brief rally in October, threatening to crumble after the strong US jobs data bolstered the case for the market punishing rates hikes from the Federal Reserve that has made the fighting inflation its top priority. With the markets also have tumbled, the very investors, they also have cut their stocks holdings this year in favor of the safer terrain, drawn by a higher yields on everything from treasuries to the money market accounts. So yet we also have some investors, they are also beginning to worry that the sitting on the sidelines could also eventually cost them once the market turns. Missing out that on a few big days of gains can also cut overall returns over time. While we also have previous market bottoms that has been marked by the furious rallies that have been rewarded those who stick it out in the stocks. So for history sites also shows that being invested in the stocks could also lead to missing out on the substantial gains where investors on the annual average return fell from 7.8% a year to around 3.2% if they miss out the 20 best stock market days over the last 3 decades. Okay, so meanwhile, with the market tends to see the strongest gains in the market after they actually hits the bottom, the firm also found that the S&P has posted a median return of about 16% during the month following the tuft of the 8 bear of the near bear market since 1980. So investors are actually looking to the next US consumer price report for clues on whether the 300 basis points in rate hikes would actually delivered by the Fed has been dented inflation, where signs that the prices of the remain steep are likely to weigh on markets, with the further undercutting the case of the staying in stocks.
Okay. So the next question here is that what are the reasons for the recent bearish sentiment in the market?
Okay, so for the bearish market, they are actually mainly also because affected by the Fed rate hike and also with the S&P. Other than this, we also have those like the European countries, they are also affecting. So with like the central banks, they are actually foresee that they are going to raise the interest rates. With the data is unlikely to dissuade the Fed from another sizable rate hike in the coming November. With investors also sees that the high bar for slowing the pace of about 75 basis point hikes. And also with the market expects that the S&P 500 earnings growth rate in the third quarter to be only around 3.2%. And if that is the case, it also would be the lowest growth rate since the third quarter of 2022. And also with the weather is affecting, like winter is coming, the Europe also still haven't figured out that the deal with the Russian on the gas cut off and the restrictions and also the other issues. With also the macro data, like the composite PMI for the Eurozone comes out about 48.1, which also extends that the slowdown to a third consecutive month, and also the points to the fastest decline in the output since January 2021, where the production in both the manufacturing and also the services sectors will fall as well.
Okay, so my understanding here is that to wrap up everything is that first of all is definitely the high inflation, and the second one I think is the recession fear. Yeah, okay, that probably caused the whole entire bearishness. Okay, so let's say if there is a recovery probably in November or December in conjunction with the window dressing and stuff. Okay, if we are seeing that recovery, which sector in particular that you think that investors should really look at?
Okay, with the prospect of the economic recovery this year, where this year should lead to a better performance on the real estate investment trust, as more people return to malls and companies may expand office space. Even though we are coming to the fourth quarter of 2022, we also foresee that in 2023 there might also be but rates might be also good stocks where the investors could look out for lah. And even though with the rising interest rates environment might also like pour on the cold water on the prospect of rates. This is also because of the high interest rate. When the high interest rate go higher, and the rates also will offer even high yields to stay attractive. So if investors who actually have been looking at the rates stocks, so I think starting this year they also have been looking throughout the year lah. So it will be a good stocks for those investors who are looking out for this.
Okay, so you reckon REITs is the sectors that will recover or to look at lah, be it defensive or recovery. Okay, so with the REITs that you just mentioned just now, can you recommend a few REITs that our fellow investors can put in their watch list?
Okay. So I think I would likely pick one for the US side and one for the local side. So if we're to on the US side, there is one REITs which are currently a lot of investors are looking out for, which is the Simon Property Group, where they has a very fat dividend yield. Simon Property Group, they actually is also one of the best run mall REITs in the United States, where the stocks has been under pressure this year because due to the Federal Reserve has also been raising the Fed rate funds, which they comes to a ripple effects that could lead to a negative effects for consumers. And yet, despite the volatile economic environment and also with the high gasoline prices, Simon Property Group, they actually reported that with the retail tenants able to achieve with a record sales per square foot in the second quarter of 2022, with an increase of around 26% compared to the same period last year. So with the group, they actually also face headwinds as long as the Fed is raising heights and the stock price could be discounted short term. And however, with the long-term investors, this could also take advantage of the negative sentiment to get in while the well-supported dividend yield is elevated. And for the local one, the local rates that I would choose is on the IGB rate. IGB rate is also one of the most popular rates around because in local side, we only have two shopping malls which is under this portfolio, which is we have Mid Valley and also the Gardens. So with these two malls, they are also one of the most renowned shopping centers in Malaysia. So both Mid Valley and Mega Mall and both Mid Valley and Gardens, they actually closed their fiscal year 2021 with a high occupancy rates of around 99.8%, also 99.5% respectively. With compared to the retail sectors end on 2021 with the occupancy rate around 72%. So this is also indicate that the rental assistance and also rebates have based on the net profit margin of around 78% in the fourth quarter for 2021. So which also means that they are the highest since the pandemic began in the first quarter. In terms of the dividend for IGB rate, they also has distributed around 6.03 cents per share to the unit holders, which represents that around 7.5% 3.7 yield. So with the recovery of the retail industry and also return to the normalcy, they are expected to see that both Mid Valley and also the gardens with the key beneficiaries.
Okay. So thank you for your sharing, Yongxuan. So just for all your information for our audience here, just for your information that you can now trade stocks in the US, in Hong Kong, in Singapore, as well as Malaysia with Phillip Capital. So at Phillip Capital, we offer a very, very competitive and attractive trading brokerage for all the markets that I just mentioned just now. Okay, so if you want to know what is our rates or how to trade all these stocks, feel free to talk to us. You can leave a comment, leave a message at the comment box. You can private message us through the messenger. Okay, so I think that is all for today, Yongxuan. Thank you, and I guess I will see you next time.
Okay, thank you, William. Bye bye.
Bye.